Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. And on tonight's show, we have Bogdan from Blackmore Capital looking at why Ramsey Healthcare stock price has spiked 20% in a day. And I asked the question, is this actually a good omen for other healthcare stocks like CSL? Then Dan Annan of Cosmos Asset Management tells us about the first local Bitcoin ETF to list on the ASX. That's going to be next week. It's a very, very interesting innovation for those people who've been interested in having a crack at Bitcoin. And then we have Ying Yi Ann Cheng from Coolabah Capital, and she tells us how many interest rate rises her boss, Chris Joy, expects for the year ahead. And we look at other issues concerning interest rates. Let's kick off with Bogdan. Thanks for joining us, Marcus.
Terrific to see you, Peter.
So, mate, some good news for some of the stocks that you hold in your fund. And, probably a few months ago, you told us you really like Ramsey. Just for those people who've missed the story, what's happened there with the Ramsey share price and the reason behind it?
So the Ramsey share price has gone from around $64 to $80 yesterday, based on a consortium bid led by the very famous private equity group KKR in consortium with Hester, which is a large industry health fund, making a bid for Australia's largest private hospital operator, Ramsey. And so it is opportunistic because Ramsey for 2 years has been greatly affected by the pandemic in terms of number of patients they've been able to treat, elective patients have been able to treat through their hospitals, and they're prized sovereign assets, and they're taking advantage of that whilst earnings are depressed to make a bid.
There's a question I always have to ask when you get a bid like this: is it likely or possible that another potential buyer might come out of the woodwork?
Quite possibly. We've seen a number of assets that have been contested, and these assets are incredibly valuable given the position that they are not only in the Australian market, they're the second largest private hospital operator across Europe, and have got a significant position in the UK as well. And these healthcare businesses are facing record levels of patient backlogs, and so the ongoing demand for the next several years is significant, and so that's why they are attractive, and it could well lead to another company or another group coming in to look at the assets. However, there are a number of hurdles that they need to get through. They need to get foreign direct investment approval. The Paul Ramsey Foundation, the founder of Ramsey Healthcare, that foundation owns around 19% of the group. And so I think KKR have been very considered in the way that they've been working behind the scenes to get, obviously, very valid consortium partners in place, such as Hester, and also probably discussions with the foundation as well, which is critical to the success of any bid coming up.
The fact that this is a key health asset and a very astute private equity group like KKR sees the potential value, what they pay today, presumably they think is going to be a lot less than what they could get in the future.
Yes.
Is this ultimately leading to a re-look at our health assets, companies like CSL, Cochlear, ResMed, and all those as a consequence? Or are you suspecting that could be what follows as a consequence of this bid?
it is opportunistic to be looking at the healthcare sector because it is significantly under-earned over the last 2 years through the pandemic. And these are, in Australia particularly, these are world-class assets that we've got in a world-class healthcare system. And so in more normal times, they're delivering in an essential service, large-scale opportunity, which are particularly attractive, I think, for cashed-up private equity. And I think Ramsey is a very strong example of the attractiveness of these assets.
Okay, so that's the case of Ramsey. What's a company like CSL been doing on the market as a consequence of this action?
So yesterday there was an uplift in the healthcare sector across the board, and the other names, whether they be in pathology, diagnostics, or in pharma, were all beneficiaries of the interest in Ramsey that we saw yesterday.
Yeah, I'm seeing CSL is up 0.25% today. It's going to be very interesting to see because I have been arguing on this program that the healthcare, a bit like tech, have been really smashed, and you kind of expect eventually, for the reasons you pointed out, that they were hamstrung by the government restrictions to try and get rid of the pandemic problems. They have, in a sense, a pipeline of business that ultimately should go and help their bottom line, ultimately their share price. So it's going to be very interesting to see how that plays out, Marcus. Some other companies in your fund, that's a Switzer growth fund, have also reported. What's the story from them?
So both Brambles and Endeavour have updated their quarterly numbers today, and pleasingly, Brambles has seen revenue growth of around 8% across the group, and so they've got operations most significantly in the United States, Europe, and Australia, and they've upgraded their guidance not both by revenue and earnings. And so that's particularly pleasing because the company is demonstrating pricing power, the ability to increase prices whilst costs are rising, but being able to push that through onto their end customers. And so you've seen a nice uplift in Brambles today in recognition of that upgrade.
And was Brambles in the fund for its potential dividend or its potential capital upside?
It's what we would classify as a classic defensive industrial company, which delivers resilient earnings, and then obviously that with that earnings growth in dividends as well. So it's a combination of both earnings growth, stability of earnings plus dividend. Okay,
so what about Endeavour? Endeavour was the breakaway, if you like, grog business from Coles.
Yes.
And it's now on its own. It's listed on its own.
Yeah.
You're holding it primarily as an income play, I've always thought, but maybe there was a growth play there as well. Was the report probably better than you expected?
The report was in line, but Endeavour was spun out from Woolworths, and so that's the Dan Murphy.
Sorry, I said Coles. I meant to say.
The Dan Murphy BWS businesses and the hotel business. And so what we're watching there is the recovery in the hotels business. And in the last 7 weeks, that recovery has been robust, which has been good. Again, it's a very stable company. It's the industry leader, and it's performing very, very soundly at the moment.
It's interesting, mate, that we've talked about businesses that potentially would benefit from the world getting back to normal, and obviously the hotel business is getting better and better. They still struggle from the fact that they've got a lack of staff.
Yes,
and also their costs have really gone up. But it's going to be interesting to see other businesses out there that may well benefit from the fact that the pubs are doing well. I'm thinking to myself, a company that I've kept my fingers crossed will improve, namely Tyro. You go to those pubs and they're using Tyro machines and stuff like that. So
yes.
that kind of knock-on effect will be interesting to see how it plays up over time.
Yeah, indeed. And also what they're seeing with the reopening of the hotels business is not only a step up there in the gaming, but also that the consumers are actually buying premium products, whether it be cocktails or meals. So, the Australian consumer is still in a very strong position, and they're in a position of wanting to spend, particularly on services now.
Yeah, well, all the money that they historically spent going overseas is now being spent on quality luxury stuff. They can't get cars, so they got to struggle.
Yeah, absolutely.
And great restaurant meals. All right, mate. Is there any other? Look, I keep getting the question. Why are you so optimistic that the stock market can do well this year? And I often say, well, I do think eventually inflation will come off the boil. I was listening to the Treasurer this morning speaking at a breakfast in Sydney. He too thinks that inflation over time will start coming off the boil, hopefully with the end of the Ukraine war and hopefully with China getting it over their pandemic problems. You are not as buoyant in your optimism about the stock market going forward as I am, but you are cautiously positive, aren't you?
Particularly on Australia, and we've talked about this before, where I think Australia, where we are geographically, and the resources that we've got in agriculture, in energies, in metals, is leading to a very strong recovery, and GDP numbers have been revised upwards. And companies, there's still more positive earnings revisions upwards than downwards. And today is a great illustration of Brambles leading that way as well. So as long as we're still in that expansion phase of the earnings cycle, which we are in Australia, dividend yields of around 4% are the highest in the developed world. And then we've got franking on top of that. But then, you need to also caution in the fact that, there are a number of challenges still on supply chains, on costs. But then that's why we've got this emphasis on buying industry leaders in very strong industries.
Okay, mate. Thanks for joining us. Talk to you in a few weeks' time.
Thanks, Peter. Cheers.
Well, the first Bitcoin ETF is likely to be launched next week. And to talk about this, we have the CEO of Cosmos, Dan Annan. Dan, thanks for coming on the program.
Oh, thank you for having me, Peter.
Okay. Tell us about this ETF that's going to be launched next week.
Yeah, so just by background, Cosmos, we've been working in the market for almost 2 years to try and deliver access to a Bitcoin or cryptocurrency ETF in the market. We've spent an enormous amount of time ensuring that we deliver a product to the market that is institutional quality, that gives investors, both retail and institutional investors, access to a cryptocurrency product. And so what we've done is partner with a tried and tested partner, Purpose Investments, out of Canada. So Purpose Investments listed the first global Bitcoin ETF on the Toronto Stock Exchange.
Yeah.
And what we've done is created a fund of funds structure whereby the Cosmos Purpose Bitcoin ETF will hold the Purpose Bitcoin ETF. Now, the Purpose Bitcoin ETF, it's about 1.6 billion Australian dollars. The structure of that product is it holds spot Bitcoin that's custodied by Gemini. And as we all know, Gemini has proven to be sort of the global gold standard in custodying cryptocurrency for customers across the globe. And so what we're doing really is delivering a high quality institutional compliant custodian from the spot Bitcoin product to the Australian investor.
Yeah. Okay. So let's imagine And by the way, is this going to be a listed product or a private fund?
It's going to be a listed product, so an exchange traded fund. Now, just to be clear, where we are with this product right now is in trying to deliver, obviously crypto asset or spot Bitcoin or spot Ether product in the market, between the regulators and exchanges wanted to ensure that, they were doing everything they can to protect the end investor when the product came to market. So one of the things that, the market had been waiting on was clearing participants at ASX Clear to come to the table to support the product. So just last week, we received word, it was actually earlier this week, we received word from ASX Clear that they have the adequate number of clearing participants to support the product. So what that means is that issuers that have product, or product applications at exchanges that are ready to go and are waiting approval from the exchanges to quote product, have 7 days, and within those 7 days, if they have the green light from the exchanges to move forward, we'll be able to list product. So that's where we sit now. For all intents and purposes, Cosmos, subject to the CBOE, will be listing product next week.
Okay, I guess people listening to this would hear ASX involvement, a Canadian company that's listed, and they think, okay, things are, the safety factors are adding up. But I guess the right question for me to ask you then is, what still can go wrong? And I'm just being objective.
Yep.
But Purpose is a listed company. It could make problems. The ASX would do its best to make sure things are done well, but at the end of the day, you're investing in a speculative asset.
That's right.
And so there are a number of high risks, and people need to be aware of that. Is that cool?
Yeah, absolutely. I mean, look, the crypto asset class, as we all know, despite being probably one of the best performing asset classes we've seen in our lifetime, at least in my lifetime, is still a highly volatile asset class, right? And to that end, I think one of the key things that a financial product like an ETF brings to the table to investors is that you now have a product that you can put alongside your other shares and actually have a view into the overall risk that product brings to the table, right? So in the past, or up until being able to deliver an ETF for this exposure, you either had the options of an unlisted product, or maybe you had an option of being able to go open a wallet to own crypto, right? So if you go open a wallet to own crypto, what that does is that you don't have the full picture from the grand scheme of things on how that looks along your other assets. Having a financial product that trades just like a share, an ETF, that gives you that exposure, you now can actually see and run analysis on what type of level of risk am I adding to my portfolio when I make an allocation to crypto.
Yeah.
And from our analysis, and I think what the market has started to see is, a simple between 3 to maybe 7% or 10%, depending on your risk tolerance, in a traditional 60-40 portfolio, can add a substantial amount of outsized return to the overall portfolio.
Okay, so for people to understand how they might make or lose money with this ETF, it's going to get down to presumably the wise buying and selling of Bitcoin by the fund manager behind the exchange traded fund. Is that the case?
Well, so there's two things. The fund manager behind the exchange traded fund is fairly important, right? So one, you want a manager that understands the asset class. Two, has a platform that's been tried and tested, right? So one of the key reasons that Cosmos came together is we have a background in crypto mining. That's how the business really started. We have a strong background in funds management, and we have also a really strong background with ETFs. So putting that combination together, we want to be the preeminent crypto asset manager in the market. Now, partnering with Purpose, right? that have been able to deliver the true and tried Bitcoin spot ETF, which listed over a year ago, that has gained institutional acceptance globally, right, gives us a really strong platform for, at the very least, I think for the investor should feel some confidence knowing that they have that combination of managers behind the product.
Okay. So imagine someone comes in next week, puts $10,000 into the ETF,
Mm-hmm.
and over the first month, the Bitcoin price goes up by 10%. How much of that 10% rise should show up in the unit price of the ETF?
Look, the tracking error for the Purpose Bitcoin ETF has been spot on. So we've been reviewing that quite some time before even making a decision to partner with them, right? And so the objective of the Cosmos Purpose Bitcoin ETF is to track the performance of the Purpose Bitcoin ETF. And we will hold the Purpose Bitcoin ETF. So when an investor buys the Cosmos Bitcoin ETFs, what we do is we go buy the Purpose Bitcoin ETF as a wrapper. And so to that question, the tracking error of that underlying and holding has been spot on to the price movements of Bitcoin. And we are going to replicate that same performance and tracking of spot Bitcoin. And so if Bitcoin moves 10%, our expectation is that the Cosmos Purpose Bitcoin ETF will also move 10%. Now there is an expense ratio, so you have to factor that into that.
Yeah, so it'd be 10% minus the cost of
trading and the cost of fees.
Yeah, and can you give us an idea of what kind of how many basis points would be involved there?
Yeah, look, we're working with the market makers on that, but we plan to be. I mean, again, for the market maker, you have to ask the question: what instruments do they have to hedge the product? Some of them have great instruments, just like being able to go short the spot price directly, right, which gives them a perfect hedge. And so we expect really I think strong schedules on the CBOEs as far as spread goes to be able to support the product.
But Dan, when do you think you'll be able to definitively say it's going to be 30 basis points or 40 basis points?
By next week.
Okay. So, okay. All right. So I've asked the questions that seem most logical to be asked by someone who might be, always hoping to get a bit of access to Bitcoin. I guess the interesting question would be, what's the minimum amount people can put in?
Yeah. So the set price that we're, and I don't know, again, just one of those things where I think it's probably best to start making these, have this conversation next week when we do go live. But we've set a set price that's tolerable for investors to be able to to get into the game with the product. I mean, what we're bringing to the product really is, and what the ETF brings to the table is that now an investor doesn't have to worry about going to basically open a wallet, remembering their passcodes, the fear of maybe forgetting that passcode, et cetera, right? That's one. Two, you have a financial product that you can look at it alongside your other assets, and define what type of risk you're looking to take on by investing in crypto.
Yeah. What kind of regulatory observance is on Cosmos and what it's doing with the proceeds of any money that people invest?
Yeah, so that's a great question. So I guess what you're trying to get at is like, where are the assets sit? Is that the question? Yeah. So and I think this is pretty. I believe it's in the PDS. So we have a custodian, a world-renowned ETF custodian that will be custodying the ETF for us locally. Again, we can discuss more into the details of that next week. We have a strong administrator for pricing the NAVs of the product every day. We have a strong market maker to ensure that investors are getting fair pricing when they buy and sell the product. And so, for all intents and purposes, given that the underlying asset is crypto, but we've put together a strong, I would say, operational team and partners to deliver, I would say, to investors a platform for them to get exposure to Bitcoin through the ETF wrapper, right?
Okay.
And so they would have, again, the underlying asset, the spot price or the spot Bitcoin would be custodied at Gemini, right? Again, a global compliant custody of crypto, as we all know, and we're really, really proud to be able to sort of partner with that team there. We have Purpose, who's been running this fund for over a year, has amassed 1.6 billion in AUD assets. At one point, it was 2 billion. Obviously, Bitcoin price have corrected over the last couple of months or a year or so. So yeah, we're fairly proud of what we're delivering to the market, and our goal has always been to be able to deliver access to this asset class for Australian both retail and institutional investors.
All right, Dan, I guess my last question would be, obviously, if Bitcoin's price goes up, it will be good for the ETF.
Yep.
But what are the headwinds? What are the kind of nightmare developments out there that, you being a Bitcoin enthusiast,
Yep.
what are the threats to Bitcoin? And I've always thought excessive central bank regulation worldwide might affect Bitcoin price, but I'm no expert on Bitcoin. What are the headwinds that investors should be aware of when they're taking a punt on Bitcoin?
Yeah. Look, I think one of the, I would say headwinds has always been regulation, right? And what I've seen in Australia over the last year is the 180 turn of supporters from the regulator, right? There's strong, I think, with any new asset or with any new investment, it's upon the regulator to ensure that they're doing everything they can to protect the end investor for products that come out. And I think as the regulator has gotten smarter around what the asset is and what it does and its potential of how we transact in the future, which is essentially what Bitcoin is. Bitcoin is going to change the way we transact, in the world of basically moving away from, to your point, the central banking system, right? And decentralizing currency for individuals. So that's where we're going with, that's the purpose of Bitcoin. But I can say that the fears that we had, which was mainly around regulatory support, there's been about, I would say, like a full 180 turn on that. We're seeing it not just here, but we're seeing it globally, right? We're seeing, Janet Yellen, being super supportive about it. We've seen local regulators being super supportive around the crypto asset, and everyone is just really. And I think as more people get smarter about what this technology is going to do for us, I think we'll start to see more confidence. Now, the asset class is volatile, right? And so, I think as an investor, it's upon you. And again, we have ample resources for you to get smarter around what the asset class, the volatility around the asset class, and how to think about that asset class as part of an asset allocation in your portfolio.
So therefore, on one hand, you're saying that the threat of central banks banning Bitcoin, that's no longer a worry for you. The flip side, I would ask, is if central banks start producing cryptocurrencies of their own kind,
then it's not decentralized.
But in the short term,
it's not decentralized.
Yeah, but if they did that, in the short term, you'd have a rival that people might want to invest in a safer kind of cryptocurrency.
Yeah.
But would you think over the longer term, Bitcoin would then be perceived as being like the Rolls Royce of cryptocurrencies, while the other, Rolls Royce might be the right terminology. It would seem to me that the safer.
I see where you're going with it, and if I think what are the threats of central banks and countries creating their own digital currency, which is. But again, if they did that, then we're back in the same system that, Bitcoin and cryptocurrency is trying to achieve, right? Which is decentralized finance, right? Now, I see digital currency sort of being part of economies, but I also see the need for Bitcoin, and the way it's structured, all right, to allow for individuals that want control of their finance and their currencies, and countries that don't want to be dependent on, I would say, G7 countries, or top relying on one country, similar, let's USD. A lot of emerging market countries are reliant on the US dollar on how the economies operate, right? And as we all know, globally, there's been massive printing of dollars, which has created this enormous inflation. And who does that hurt, right? It hurts these emerging countries that are relying upon the US dollar to actually operate. And most of them are trying to pull away from that. So I can see, a world where emerging countries gravitate towards Bitcoin, and, developed nations, create their own digital currencies, and it can be interchangeable. Again, that's my view of sort of how things can evolve over long term. But from where we are today, I don't see, I think we're moving in the right direction of acceptance of Bitcoin being part of the way we transact.
Okay. Dan, thanks for joining us, and be interested to see how it all goes next week.
Thank you very much.
Well, joining me now is Ying Yi Ann Cheng from Coolabah Capital. Good to see you, Ying Yi.
Good to see you, Peter.
All right, a lot of stuff's been going on since we last talked, and there's speculation that the Reserve Bank might raise interest rates in June. A lot of the banking economists agree with that sentiment. What's the view from Coolabah?
Yeah, we tend to agree with that view. So yes, the RBA has signalled that they are likely to hike, and that they're ready to do so. Obviously, we have the May election coming up, as you are well aware. So it's likely that the RBA will go after that. So it could come as soon as June in terms of the first rate hike.
Yeah, okay. Would that first rate hike be 15 basis points to round it off at 25 basis points?
It's likely going to be 15 basis points to round it off to 25, and then they're probably thereafter 25 basis point increments.
Okay. Now, the increments, there's debate out there. I think the most aggressive economist I've seen says 8 rises in a year. Tim Toohey from Yarra Capital thinks more like 3 is going to be on the cards. What's the view from Coolabah on the number of rate rises in a year?
Yeah, so the view at Coolabah, whether it's from Chris Joy, our Chief Investment Officer, or Kieran Davies, our Chief Macro Strategist, or even amongst the team, the broad consensus from Coolabah is actually 2 to 3 rate hikes in terms of this year. 8 hikes is probably too much. Yeah. I must say that the wage and inflation outcomes currently in Australia are much more benign than the US, so we can't put it on the same scale. At the same time, with all of the leverage in the system in the Australian economy, and the fact that mortgage rates, most people in Australia actually have floating rate mortgages. Sure, the makeup of fixed rate mortgages really went up post March 2020 because a lot of the banks decided to issue fixed rate mortgages. However, we have a lot more floating rate mortgages than we would have in the US. So hence they need to go a lot more aggressively in terms of their cash rate hikes than we would. So, 1 hike here is definitely something that the Australian economy is much more sensitive to.
Yeah, okay. So let's put this in context then. Over the tightening cycle, where do you guys think the cash rate might end up?
Yeah, really, really good question. Look, we think that the RBA will struggle to hike past 125 or to 150 basis points. So 1.25 or 1.5% is where we think that the RBA will land in terms of their terminal cash rate. And as I said, we have much more benign wage and inflation pressures here. So that's driven by that. And primarily, as I said, a variable rate mortgage market that makes cash rate changes much more impactful.
Okay. Ying Yi, if the most positive outcomes develop over 2022, namely a settlement of the Ukraine-Russian conflict happens, driving oil prices down, and then China overcomes its pandemic problems and releases a lot more of their people from lockdown. So our supply chain problems start to become still an issue, but less of an issue. That to me makes me think that inflation could end up by the end of the year, if those two things happen, are lower than what is the expectations right now. Would that, if that's right, would that then lead to the expectations of the number of rate rises in the US to be peeled back? Is that a reasonable conclusion?
I mean, I can see how you've approached that conclusion, and I definitely think it could have a role in terms of, lessening the pressure for like hikes in the US, although what is driving the hikes in the US is this potential wage and price spiral. So a lot of those supply chain pressures and the pressures coming from oil prices, they only serve to exacerbate what was already happening in the US already, which was essentially, wage prices going higher because they have an incredibly tight job market or labor market as such. You need to remember that, in terms of immigration, although they haven't had closed borders, they have had quite tight immigration policy post-Trump. And so they have a very tight labour market. And look, Australia is not too dissimilar in the same respect as well. Unemployment rate is at an all-time low. And, in the US, unemployment is also at an all-time low. So with a tight labour market, unless we have, rate hikes to address that potential wage price spiral that could entail, then yes, we don't really see that slowing down as such.
So in terms of the Switzer High Yield Fund, how has it performed over the past 12 months?
Yeah, so the Switzer High Yield Fund has delivered 0.37% net of fees. In the context of the benchmark, it has underperformed its target return of the RBA cash rate plus 1.5%. However, in the context of traditional fixed income benchmarks, it has substantially outperformed. So notably, March was a very, very interesting time. So March was actually the worst month in history for the Ausbond Composite Bond Index, which is the traditional fixed income benchmark. So that particular index fell by 3.75% just in the month of March. And it also had very poor months over the course of 2021 as well. In fact, if we look at the March quarter, so the first quarter of this year, that index also fell by 5.88%. So that was the worst quarter in the history of that index. And that is a traditional fixed income benchmark. So anyone who, typically would use a fixed income benchmark like that would have done quite poorly. In addition to that, if we look at a zero duration index, so 100% floating rate sort of fixed income benchmark, whereby there is no interest rate risk. So most people would say, okay, well, as rates move higher, how am I going to fare? So in the context of the Ausbond Composite Bond Index, which I just mentioned, as rates move higher, having fixed rate risk is going to be bad for you. That's why we had a negative month and a negative quarter this year in that benchmark. Whereas for us, we did reasonably and relatively well. In the context of a floating rate note index, that still had a very poor month in March. So that still fell 0.29%. And the Switzer high yield fund net of fees was only down about 7 basis points or 0.07% compared to the floating rate note index, which actually declined in that month about 0.29%. And that was actually the third worst month for that particular index as well. So in the scheme of things, a very, very difficult time for fixed income, but the Switzer high yield fund has done comparatively well.
So given that that is a bond fund that goes after floating rate bonds, with interest rates on the rise going forward, should that be good for the fund?
Yes, so it will be comparatively good for the fund versus, say, fixed income benchmarks like the first one that I mentioned, the Osborne Composite Bond Index. And that's how we've always, approached our investment philosophies. So we prefer keeping what is called interest rate duration or fixed rate risk near 0 years, because ultimately we do see inflation normalizing. And there obviously is also a concern, around, inflation rising and therefore obviously rate hikes as such. So as interest rates or cash rates move higher, the underlying coupon of the bonds that we own inside the portfolio will also move higher. So the income will also increase as a result. Whereas if you were in a fixed rate fund, that would be a completely different story.
That was Ying Yi Ann Cheng of Coolabah Capital. And that's the show for this week. We're not operating on Monday. It's a public holiday, but we will be back in action on Thursday. I hope we see you then. And if you're interested in getting more analysis on stocks, have a look at the Switzer report. Go to switzerreport.com.au. Thanks for joining us. See you.